I'm going to show you how to grow a small account using option trading strategies called the Iron Condor, which is literally the #1 strategy for growing a small account fast. I've actually ranked every option trading strategy against each other, and I put the Iron Condor as #1 because it's so profitable yet has such a balanced risk to reward ratio. The Iron Condor is the ultimate strategy for someone that has little money to invest but wants to scale up as fast as possible. So if you have a small account that you want to grow and you're not using the Iron Condor, you are seriously missing out on a lot of easy money. This guide will address step by step with examples how to print money with Iron Condors and manage each one effectively. I'm going to teach you what an Iron Condor is. I'll go through easy examples. I'll show you exactly what you need to look out for to set it up, and I'll show you exactly how to use the Iron Condor to grow a small account consistently and pretty much passively by setting it and forgetting it. Now, if the stock reaches one of your break-even legs, of course, I'm going to show you how to roll and manage the position so you don't lose any money. So first, what is an Iron Condor? An Iron Condor is an options trading strategy made up of 4 legs or 4 different options, 2 calls and 2 puts. If you're not familiar with calls and puts yet, go watch my option trading beginners full course, which is 4 hours for free on YouTube. It's the best free course on YouTube. I'm going to link it down in the description, or you can also check out the top right here on the screen. So now, to make an Iron Condor, you first go above the current price and you want to sell a call option. Then below the current market price, you want to sell a put option. Now, if you don't already own at least 100 shares of the stock or have the money to safely buy it, this would be a very risky strategy in and of itself. Currently, these are naked options. When you sell a call and you sell a put, these are 2 options that are open and have a lot of risk. So to complete the Iron Condor and add protection, we're going to buy a call above the call that you sold, and then we're going to buy a put option below the put option that you sold. If you're familiar with a credit spread, you can easily see how this is just 2 credit spreads. These are 2 credit spreads combined. One is going to be a call credit spread above the market price, and the other is going to be a put credit spread below the market price. And all you need to know is that the objective of a call credit spread is for the stock to stay below the price of the call credit spread. So if you've sold a call credit spread with a strike price of 100, you want it to be below 100. Now, for put options, it's the opposite. So when you have sold a put option at, say, 80, you want the stock to stay above 80. So with those 2 objections combined together, now you can see for yourself what an Iron Condor is. In a lot of option trading strategies, you need something to happen to the stock price in order to make a profit. But in the case of an Iron Condor, you don't need anything to happen. In fact, when the stock moves sideways, that's exactly when you are making money. In fact, for you to make a profit, you can actually say the stock needs to stay within the range of the strike prices that you pick, which is exactly what makes this strategy so profitable. If you can find a stock that's in a sideways action and it's just moving a little bit up, a little bit down, or if it's going sideways, this is the perfect strategy to use on a stock that doesn't have that much volatility. However, I will point out that the more volatility a stock has, the more premium the options will have. So the Iron Condor will collect more money. However, you can easily find a balancing point. You can find a sweet spot where basically you can make good money without having too much risk. Because as long as you pick the right stocks and then you know when to enter, the vast majority of the time, you're going to be profitable. Of course, unless there's some big event, unless there's a lot of volatility, unless you know what happened with Japan or some big event like a COVID or a huge earnings event, which, by the way, you can avoid. You can avoid the earnings events. There are a few things that can make the Iron Condor, sour, and you can lose money, of course. No strategy is bulletproof. But for the most part, if you listen to this video, you're going to have a step-by-step guide to understand that this is one of the most profitable strategies. It takes a little bit extra work, but it's the fastest way to grow a small account. And you can capitalize off that. With the regular stock investor, they're waiting for big moves in the market. But as an Iron Condor trader, you really don't have to worry about that. The power is in your hands. You can just lay back, relax, and if nothing happens, then you actually end up making money. So you're kind of in the reverse situation where people that are buying options, they're hoping for a move up, they're hoping for a move down. But with the Iron Condor, you're hoping for basically nothing. You're just kind of relaxing. So another great thing about the Iron Condor is that you'll know exactly how much you can lose, because once you enter the trade, you see how much you're risking. And you also know exactly how much you can make, because when you sell an Iron Condor, you get the premium up front. So the cash enters your account. Now your account value won't change because you have some cash that enters your account, but you still have to wait for that option premium to decay. Let's say a stock is trading at $100 per share, and I don't think it's going to make any big moves in the near future. So I decide to trade an Iron Condor with an expiration date, let's say 30 days. First, I sell a call option with a 105 strike price, and then I sell a put option with a 95 strike price. Then I go ahead and buy a call option with a 108 strike price, and I buy a put option at the 92 strike price. For here, let's say that you get paid $2 in premium for selling the call and another $2 in premium for selling the put. That's $4 in premium. Let's say we're doing one contract. That's $400 that you will be collecting into your account. But we also bought a call option and a put option as well. So that's going to cost us, say, $1 each in this example. So that's $2 in cost. That means that you're going to collect $400 and we're going to subtract $200 because you paid $200 for a net profit of $200. So we get paid a net profit of $200 to enter the trade. Now, let's see how this plays out in different scenarios. Okay, so the first scenario, the stock stays within the range of the short options. In this case, both calls and puts expire worthless, meaning you get to keep your $200. That was yours in the very beginning, and now the options expire and it's still yours. This is the best case scenario, meaning our entry price of the $200 that we got is the maximum amount that we can make. We got paid that and we keep that. Nothing more happens. Nothing else needed, and the options expire and your capital is free. You can do this all over again. And you can repeat this as many times as you wish. Now, in scenario 2, the stock shoots up to $110. If the Iron Condor expires with the stock at $110, then the puts will be worthless, but the short calls will be worth $5. So you're going to lose $500 to close that leg of the trade. But since we bought that long call, we're going to make $200 back. So to close this trade, we'll have to end up with a total loss of $300. But again, since we got paid $200 to enter the trade, we actually only lost $100. So that is our maximum loss, is $100. If you want a formula to calculate your max loss, all you need to do is subtract the amount that you get paid to enter the trade from the width of the strikes. So in this case, the width of the strikes was $3. And to get our maximum loss, we subtracted our entry price of $200. In scenario 3, let's talk about the stock going down. Let's say the stock goes down to $93, so it expires in the middle of our 2 put strikes. In this case, the call will be worthless, so we don't need to worry about that. Now, the short call will be worth $2 because it's $2 in the money. So we'll lose $200 on that leg. And the long call will be worthless since it's out of the money, so no change there. Our net outcome is $200 that we lost plus $200 that we gained for entering the trade. So we actually hit something called the break-even price, and we hit this break-even price point exactly, meaning that we made $0. The formula for calculating break-even is our short calls plus the premium we receive, or our short puts minus the premium that we receive. And those are the 2 break-even points for an Iron Condor. Now that you know how an Iron Condor works, let's go over which stocks you should pick for it and what indicators you should look for when setting up this trade. So for small accounts, the stocks that I recommend for an Iron Condor are going to be the blue chip stocks that I typically recommend. Now, I want to point out that some of the best stocks are going to be Apple, Google, Microsoft. But I would also say some of the more volatile names like Netflix could be a fantastic choice. Any stock that has a good amount of volatility, for example, Netflix and Palantir, these type of stocks can provide a lot of volatility, which has a lot of premium, which is fantastic. But if you've actually taken a look at the chart of Palantir, it actually goes up a bit, down a bit, up a bit, but it's typically moving sideways. Now, what you want to do is you want to find a stock that is somewhere in the between its Bollinger Band. All right, so I'm going to take a look at Tesla right now because I want to show you what the middle of the Bollinger Band would look like. Now, right now, we've come across a lot of volatility in the market, so we've had a big pullback, and the Bollinger Band has actually expanded. But you can see here that essentially the stock was in a very good range-bound place. But essentially, you can see that you want to spot a stock that does not have a whole lot of up and down volatility. So here, Tesla was in a very strong range. This would have been a good time to run the Iron Condor. Obviously, right now, this would not be the ideal time to run an Iron Condor. You want to find a stock that has a lot of stability. So let's take a look at a better example than Tesla, because that was an example of what you don't want to do at the moment. And the same thing would apply for Coca-Cola. You can see how Coca-Cola continues to rise. So this also won't be a good Iron Condor candidate. One of the most difficult things, by the way, finding a good Iron Condor is that you need to find a stock that's just basically trending sideways. And right now, we see a lot of bullish activity in the market, or we recently saw a lot of bearish activity. So it is a little bit difficult. You do want to use this strategy when the market is more or less just moving sideways, or the Bollinger Band is sideways. Now, this is actually a good example right here on Meta, because although Meta is experiencing volatility, it's actually not experiencing that much volatility. Over the past, if I go to 6 months, this stock has actually done nothing, actually nothing. So this is the perfect example. In fact, 6 months ago, if you would have done an iron condor on Meta right here, okay, so Meta was at 468, and you would have sold some call options at, for the call side, right? You sold a 520 call and bought a 530 call. And then you would have sold on the bottom end. I'm going to show you a really good example right now of how much you can even make. Let's say you sold a put credit spread, or the put side, you sold a put at 450, and then you bought at 440. That would have literally printed money. So let me show you exactly how much money that would have printed. And because Meta is still around the same points, I can basically show you a 6-month trade right now of what that would look like. Let's just say Meta, again, doesn't go up or down that much. It's going to stay about flat. So I'll start off with going out 6 months. So 6 months would be roughly 196 days or so. So I'm going to sell a put option. I think we said that the bottom is going to be 450. You can see the bottom of the Bollinger Band here is 450. We actually got a really big bounce from even 453 level, but let's just go for 450 just to be safe. So we're going to sell a 450 put option, and then we're going to buy a 440. So the width here is going to be 10. All right, so this is going to be a 10 width. You can already see that the return is pretty good. You're risking $765 with a profit of what you're going to collect of $235. But that's just the put side. Let's go to the call side. All right, so on the call side, let's say we really don't think it's going to rise above the 520 mark. Okay, so like I said, 520. If you did this 6 months ago, it would be a money printer. So let's say that I go ahead and do a 520, and then I sell the 530. So again, I'm going to go for 10. Right here, you can see how you're going to be risking about $265 to make $735. So essentially, this is a 3x return. So for every 265 or 250 bucks, you're getting 750, more or less. You're getting a 3x return on an iron condor. Here, you're getting 3x, 300% in 6 months. 3x your portfolio in 6 months, and then you can do this again, right? If it stays between this profit zone. So as long as it's in the green, that's where you have profit. Now, if it goes beyond your break evens, this is where you will have to start thinking about managing the position. Now, in terms of managing this position, you really want to look out for momentum. So again, I look at the Bollinger Band. So right now you can see Meta is shooting up beyond the Bollinger Band, but it's not really that likely to shoot up for multiple reasons. First of all, the Bollinger Band itself is saying that Meta is a little bit overpriced at the moment. It's at the top of its range based on statistics, which is what the Bollinger Band is. Now, second of all, I want to point out that there is a double top here. So if I draw a line here, you can see that back in April of 2024, Meta topped out at 527. And then again, we basically have it somewhere in July of 2024, a couple months back now. This is, again, a hard top. So it doesn't really look likely to me that in the rest of 2024, that Meta should really rocket beyond the $530 mark, or even $520 in the short term. So if I were to make a 6-month bet, it would be about $530. If it was a little shorter, it would be about $520. Give or take, $520, $530 seems to be a very big resistance point for Meta. Now, if they do have good earnings, then in 2025, the stock could go up a lot. But again, based on statistics, right now, this is a solid level for Meta to do the Iron Condor strategy. Let's just start off with NVIDIA. Well, let me pull up NVIDIA on a chart. Let me just show you real quick some technical analysis. If I go to the chart, you will see that NVIDIA has shot up a lot. It has increased a lot in value. That is potentially, it's at the top of its Bollinger Band. That means that in the short term, I don't think NVIDIA is going to rise too much more. In fact, I'm probably going to go ahead and open up an Iron Condor play right now. All right, so it shot up a lot, but I am bullish on it. I think a lot of people are bullish. I think it could come back down, but it won't come back down too much. The moving average is 109, and the Bollinger Band middle is 112, and really good support at 95. That's the bottom. All right, so what I'm going to do is I'm going to go a little bit higher here. If I zoom out, you can see that there was a peak right here at 135, another peak at 135. It's actually a very clear pattern at 135, 135, you see? So I don't think we're going to shoot up to 140. In fact, I would say 140 would be highly, highly unlikely. But there's also a lot of, this was resistance. by the way. I apologize. Support would be right around here, around 103. We had a really big bounce from the $98, $99 level. And then there's just a huge rally back in the day. We surpassed 100 easily. This was back in May. So right now, I think that NVIDIA will trade between these two. So I'm going to set up what's called an iron condor. So first of all, I am going to sell a put option. All right. So the put option I'm going to sell is going to be, a bit lower. It's going to be around that 105 level. I already have the 105 opened up. So I'm just going to be increasing my position since I already did this on Monday on Discord. So I sold a put option. Now I'm going to buy a put option. This put option right here that I sold is at a 12 delta. It's very low, very far out of the money. Okay. So the chances of getting assigned here are very, very low. All right. If the position goes to 105, I will look to close out the position. In terms of managing the position, I will look to close it out. So now I'm going to go ahead and buy a put option. I'm going to go ahead and buy it at 105. I like a gap of $5 here. That's a, good gap. Not necessarily 4 or 5 or 10 or any of that is better, but 5 is just very easy to manage. So on both sides, I'm going to be doing that. As you can see here, Robinhood has this as a put credit spread because I have sold a put option. I have bought a lower strike put option, collecting a premium of $55 so far. I haven't executed the trade, but I'm going to be up $55 if I execute right now. All right, so this is a put credit spread. To open up an iron condor is just a combination of a put credit spread and a call credit spread. So as I mentioned, I don't think NVIDIA is going to go up above 140. The option premium here is very, very high, likely because we do have earnings coming up. So in that case, I probably want to go even higher. So the Bollinger Band, we're at the top. It's unlikely to go to 140, but because there's already earnings coming up, I'm going to be very, very cautious, and I'm actually going to go up and pick a very low delta. All right. Now, I'm being more cautious than needed, I think, but, I'm going to go for a 155. So let's go ahead and sell the 155, and then I'm going to go ahead and buy the 160. All right. And now you'll see that this is an iron condor, short iron condor. I will collect around $108 to $115. Let's hit continue here. I'm just going to do 15 contracts, and let me go ahead and try to collect 1.12, all right? $1.12. I can go for $1.15, but I want to make it nice short and be efficient. So there we go. We got filled 15 contracts. So on the put side, we sold 105 and 110. All right. That is good. So that is NVIDIA. Now I'm going to go ahead and do Tesla. These are basically the two spreads and the two stocks that I think are very good for trading spreads. There's a lot of volatile, which is a good thing. There's a lot of volume. You can see that I do have several positions on Tesla. I'm up $1,600. I have some call credit spreads, some put credit spreads, and some short puts. All right. Should I quickly check and see when the earnings are? So October 16th, so I won't have earnings to worry about. The stock has traded as high as 263 in the past 3 months. And we had a hard bounce from the 191 level. So you can kind of see a pattern here where we have a peak, we have a valley, and now the stock's in the middle. This makes it a good candidate for an iron condor again. So I will go ahead and do an iron condor for September 20th. Now I will also put Tesla briefly on I'll put Tesla here on a chart so you can see the Bollinger Band as well. Put this on a chart. Yep, so we have it in between. The top is 235, the bottom is 18. So let's open that up. I'm going to go a little bit faster this time. Again, I'm going to go to sell put, pick September 20th, 31 days out as I'm making this. So I'm going to go down, and I think $200 level will be really good, but just for safety, I'm going to go for 195. So you see how I'm being extra conservative. I'm going to sell 195 and then buy the 190. And then I'm going to do the same. I'm going to go to the sell call, and the top was 235. I'm going to be extra cautious and just go 250. Now, why did I pick 250? Well, I know 235 is already pretty good for the top of the Bollinger Band. 250, intuition tells me it's going to be lower than 30 delta. In fact, it is. It's 24 delta. There's a lot of volume, and I already knew that because 250 is a nice round number. A lot of traders are looking at it. So, all stuff that I already prepared for. Yeah, intuition tells me 250 is good. So I'm going to sell the 250, and then I'm going to buy the 255. And now you will see an iron condor has been made again. I'm going to continue. I will do 10 contracts. I already have some open. And then I'm going to go ahead and sell this for 1.6. Hopefully, you saw that there's a low likelihood.
Instead of 1.6, just so I get executed faster, I'll go 155. You can always play around with this. You can set limit prices for how much you want to get filled for. There you go. I did get filled.
Now you know exactly how to grow a small account with Iron Condors. Use this strategy with 5, 10, or even 15% of your portfolio. 15% of your portfolio would be slightly on the riskier side because, again, you want to stick to my bread and butter strategies. You can listen to a whole video on my bread and butter strategies, my 4-hour free course. That's going to be linked down in the description. And I want to let you know that I do have a 6-week boot camp. During that boot camp, I am coaching you hands-on. I'm showing you how I pick stocks, how I am trading. There's going to be some live sessions, and I'm showing you how to get to retirement. So if you're interested in the 6-week boot camp, that will also be the first link in the description where you can learn more about my program, how it works, and how I can help you reach financial freedom and retirement.